Hello everyone. This is the last video this week, and in this video I'll be talking about the technology and the payment system in Australia and also some regulatory issues with regard to technological risk. Technology has played an increasingly important role in the speed and efficiency of the Australian payment systems. However, these changes have also generated commensurate risk. Consumers have taken on technology to an increasing degree, and the pace of uptake is increasing. This transition to the use of more technology-enhanced payment channels is reflected in the payment system statistics emerging in recent years. For example, if you look at this table shows the non-cash payments for retail transaction, and it reveals a steady decline of checks as payment channel, with the number falling nearly 12% per annum from 2007-8 to 2012-2013. So you can see that check payment has been declining by about 8.9%, I'm sorry, I said 12%, about 8.9% between 2006, 2007 to 2010, 2011, although there has been a very steady growth in the non-cash transaction. For example, you can see the total transaction where grow by 6.5%, and these are all the non-cash transaction growth, and which ranges between 4.5% to 12%. The payment through check has actually declined by 8.9%. So overall, non-cash transaction grew by 6.5%. However, the check transaction actually declined by 8.9%. The decline of check uses actually contrasts with the substantial increase in the use of debit cards. You can see debit cards increased by 5.4%, credit card 5.6%, as well as bill pay by 8.8%, and also debit cards by 12%. So all forms of non-cash payments apart from the check actually increase over the 5-year period. The change in the preference of the payment choices can also be understood by looking at this graph, which is the non-cash payments per capita between 1996 to 2011. And you can see the debit cards and credit cards payment has been increasing at a steady growth, and so is the bill pay, direct debits, direct credit, and all. However, and you can see the growth in check payment has declining at a steady rate over the period. Now, this consequent growth in the non-cash payments, particularly by debit, credit cards, and bill pay, and the value of electronic and internet transaction has obviously required a significant investment in the ICT infrastructure, and that actually was needed to deliver the payment system options. In the financial year ending June 2013, more than 60% of non-cash transactions were actually card-related transactions. This table shows that of all online payments, the most popular channel is the internet banking, because you can see that about 50% of the online payments, or 50% of the non-cash payments were made by internet banking. This information actually reflects the variety of uses of internet banking, including wages, the salary payments, personal transfers, and some types of corporate payments, followed by credit and debit cards, bill pay, and other specialized online payments. In Australia, high-value payments are settled through the Reserve Bank Information Transfer System, the RITS, as we discussed in one of the previous weeks, which is owned and operated by RBA, Reserve Bank of Australia. RITS is a real-time gross settlement system in which most transactions are settled as they occur, that is one by one across the financial institutions exchange settlement account held at the RBA. In some cases, REITs also settles batches of payments. So you can see this figure, which actually shows the real-time cross-settlement transactions daily average between 1999 to 2011. This graph shows the number and value of RTGS transaction. Apart from the drop after 28, you can see that there was a slight drop here. Particularly due to GFC, there has been a steady, for the rest of the period, there has been a steady uptrend in the volume of transactions. Similarly, there was an uptrend in the value of transactions to 2008, although there was a slight decline afterwards. Now, the risk that arise in an electronic payment system, the growth of electronic commerce in financial services has revolutionized the provisions of banking products through improvements in the timeliness, accessibility, and the ease of use of the payment system. However, electronic commerce has exposed financial institutions to added risk, whether accidental or malicious, as various information systems share the banking and other details of those making and receiving payments. Some analysts and regulators view settlement risk or daylight overdraft risk as one of the greatest potential source of instability in the financial markets today. In this case, one or more financial institutions may fail to settle their obligations with the other financial institutions. Through the normal course of business, financial institutions receive payments from and make payments to other financial institutions during the day. For periods during the day, and financial institutions may need to make a payment before it receives sufficient funds to cover the payment. If the financial institution makes the payment, they will run a daylight overdraft on their accounts at the central bank. In Australia, this is unlikely to happen as the RBA requires that and financial institutions exchange settlement account must be in credit at all times and provides liquidity services to banks to ensure that this happens. This is a feature of the Reserve Bank's RTS, a system designed to minimize settlement risk. RITS incorporates the financial institutions' exchange settlement accounts and the real-time cross-settlement system. Exchange settlement accounts allow financial institutions to settle transactions through the adjustment of credit balance held with the RBA, where the RBA acts purely as settlement agent and is not exposed to any credit risk with individual financial institutions. Apart from this daylight overdraft risk, the technology and the payment systems are also exposed to a few other risks. For example, crime and fraud risk. The increased replacement of checks and cash by electronic payment system has resulted in new challenges for financial institutions and their customers regarding theft, identity theft, white-collar crime, etc. Some financial institutions, employees, for example, have a specialized knowledge of personal identification numbers, passwords, and similar, which may give them the opportunity for theft. If we take an example, a manager at the Sri Lankan branch of the now defunct BCCI reportedly stole a computer chip from a telex machine in the bank's Oman branch and used it to transfer $10 million from 3 banks in the United States and Japan to his own account in Switzerland. Regulatory risk. The improvement in financial institutions' ICT networks also enhances the power of financial institutions vis-a-vis regulators, effectively aiding regulatory avoidance. Thus, as implied earlier, Regulation not only can affect the profitability of technological innovations, but can also spur and hinder the rate and types of innovation. As a result of regulation in many countries, banking in the relatively unregulated tax havens have experienced considerable growth, catering to the needs of the largest global corporations. Um, Tax avoidance, the development of international electronic fund transfer network, as well as international financial services firms as a novel financial institutions to shift funds and profits by using internal pricing mechanism, thereby minimizing their overall Australian tax burden. The issue has become to the attention of the Australian Tax Office, which in 2010 requested information from 57 banks and financial institutions, which it planned to use in conjunction with its own records to identify taxpayers who have not disclosed offshore income and who have used tax havens to minimize their tax illegally. And competition risk as financial services become more technologically based, they increasingly compete with non-traditional financial services suppliers. Examples have appeared in the mortgage market, with non-bank financial institutions creating a market share for mortgages, credit cards via companies such as Aussie Home Loans, RAMS, and so on. In addition to offering enhanced credit card services in competition with bank-supplied credit cards, the Australian arm of General Motors owns a finance company, GE Money. Supermarket giants Coles, Woolworths are also reported to be collecting data as they prepare to compete with financial institutions on home loans. Thus, technology exposes existing financial institutions to the increased risk of erosion of their franchises as costs of entry fall and the competitive landscape changes. Like technological risk, the other sources of operational risk can result in direct costs, for example, loss of income, indirect costs, for example, client withdrawal and legal costs, and as well as opportunity costs, for example, losing or the foregone business opportunities for financial institutions that ultimately reduce profitability and value. To offset these costs, financial institutions managers spend considerable effort and resources to prevent, control, and finance and insulate financial institutions from losses due to operational risks. The management efforts include loss prevention. The loss prevention typically takes place in the form of training, development, and review of employees. Loss control, for example, the planning, organizational backup, data housing, loss financing, such as external insurance, and loss insulation, including financial institutions' capital. Risk management efforts come at a cost to the financial institution, and the greater the commitment of resources to risk management efforts, the lower the cost resulting from operational risk. However, the resources spent in preventing costs of operational risk may, at some point in time, be greater than the cost of risk itself. In maximizing profits and revenues and values, financial institution will invest in these risk management efforts until the cost of such efforts just offset operating losses from not undertaking such efforts. Now, regulatory issues. As stated earlier, operational risk is the risk of direct or indirect loss resulting from inadequate or failed internal processes, peoples, or systems. Certainly, as financial institutions use technology, use of technology increases, operational risk increases as well. Now, regulators have recognized the significance of operational risk for financial institutions. Specifically, in 1999, the Basel Committee on Banking Supervision said that operational risks are sufficiently important for banks to devote necessary resources to quantify the level of such risk and to incorporate them into their assessment of their overall capital adequacy. In its follow-up consultative documents released in 2001 and 2003, the Basel Committee proposed three specific methods by which depository institutions could calculate the required capital to protect themselves against operational risk. These are the basic indicator approach, the standard approach, and the advanced measurement approach. Research has found that the amount of capital held for operational risk according to these models will often exceed capital held for market risk. We discussed the standardized approach of the capital adequacy for operational risk last week. So this is the end of our discussion this week, and essentially we discussed about operational with a particular emphasis on technological risk and their impact on the financial institution services productions, revenues, costs, and briefly the regulatory issues. Thank you very much.